If you're looking to purchase a home, I'm going to show you exactly step by step how to qualify for a home loan, and I'm going to show you exactly what are some of the most popular mortgage programs available for home buyers in 2021, and it all starts on this video right now. Hey, what's going on, guys? My name is Marcos, and on this video I'm going to share with you what are some of the requirements that mortgage lenders are looking for home buyers. I'm going to talk to you about the mortgage programs available right now in 2021, and also we're going to be talking about where should you go and get a mortgage and why, and what are some of the pros and cons of each place that you can go to go and get a mortgage loan. Now, I am a mortgage loan officer. This is exactly what I do for a living, and basically I'm going to be sharing with you literally step by step on exactly the things that I show my clients personally in my line of work on, whether they are first-time home buyers or they've bought a home before. Whatever the case might be, I'm basically going to be sharing with you all my expertise about home buying through this video, at least as a normal guide that you can take and come back and rewind over and over and over. Now, if you guys find any sort of value in this video, make sure that you give it a like, subscribe to the channel, and most importantly, really, share it with a friend, share it with people that you feel will also find some value as well. Now, let's go ahead and get started. But actually, before we do, I got to tell you something. This video will be a little bit long, and the reason why it's because it really is sort of a comprehensive guide for most people who are looking to purchase a home. And this is really going to be a lot of great information, especially if you are looking to purchase a home for the first time. Now, I'm going to be breaking down this video in 3 different parts. The very first part is going to be the requirements of buying a home. The second part about this video is going to be about the mortgage programs available, through the government. So in some sort of way, the government is involved in, in these programs. And then the third thing that we're going to be talking about is really, where should you go and get a mortgage loan? All right. So the very first thing that we're going to be talking about is the requirements of qualifying for a mortgage loan. Now, there are going to be 3 main requirements that you need: credit, income, and assets. Let's talk about the first one, which is credit. And when I talk about credit, I'm talking specifically about 2 things: your credit report and your credit scores. Now, credit scores, hear me out on this. Mortgage lenders are looking at all 3 major credit bureaus. There's TransUnion, Equifax, and Experian. These are the 3 major credit repositories. And really, mortgage lenders don't care about a single one of them or just one of them specifically. The credit score that mortgage lenders are going to use is the one that falls in the middle. So I'm going to give you an example. Let's say that Experian has you at a 720 and TransUnion has you at a 680 and Equifax has you at a 640. From all 3, the mortgage lender is going to be looking at the middle one, which is TransUnion at 680. Very simple. We don't take an average. It's just whichever credit score that falls in the middle, that's the one that helps you get qualified. Okay? Now, if you want to get the right information about this, what you want to do is you want to go and apply for a mortgage so that the mortgage lender can pull all 3 credit bureaus. But if you want to do it yourself, you can go to each one of these credit bureaus personally and look at the credit score. Now, there might be a fee in order to do that, but that would be really the way for you to check out what really your credit scores are. Now, as far as the credit report goes, obviously, you got to make sure that that you are paying your things on time. So you have credit cards, you have personal loans, you got, car loans, student loans, whatever the case might be. You want to make sure that things are, paid on time because, understand, guys, that you are looking for a loan that is, in most cases, hundreds of thousands of dollars. And it just goes without saying that mortgage lenders want to make sure that you can actually pay it back. So your credit history is going to be really important. Now, it's okay if you have had some things in the past. Maybe you've had a car repossession. Maybe, you had a credit card that went into charge off, or you have a few collections here and there. Those things are fine. They don't mean that they won't get you disqualified for a mortgage loan, but you definitely want to address each one of them because it will be important. And you want to be upfront with the mortgage lender as well and tell them as to why those things happen and what are some of the things that you're doing in order to, to show that you are responsible, that you are financially responsible, and you can definitely take on a mortgage loan and you won't be behind on the loan itself. So if you are, looking to qualify for a home loan and the very first thing that you're doing is checking your credit, make sure that you go through the credit report as a whole. You can go to annualcreditreport.com. I'm going to actually be linking that website on the description box of this video, and you can actually check your credit report once a year for free and no questions asked and you can check your credit report from each credit bureau. All right, so the second biggest requirement is going to be your income. And mortgage lenders are going to be looking for a stable 2-year income history. Now, most people will fall in 2 different categories. You're going to have people who are self-employed, and you're going to have those who are employed by a company. Let's talk about the first one, which are going to be self-employed. If you're self-employed, sometimes it is a little bit more difficult to qualify for a mortgage loan because you will have to provide 2 years of tax returns to the lender. And, this is really important for you to know, because most people who are self-employed have the ability to basically deduct every single expense from their line of work. That's going to help you with your taxes. The problem is that it won't help you get qualified for a mortgage loan. So before you guys, file your taxes, you want to talk to a mortgage lender, you want to talk to a CPA, and sort of come up to a strategy that's going to help you, maximize your income for the mortgage loan, but also making sure that, that you're paying your fair share of your taxes. People who are self-employed are typically, obviously, you own your own business, or 2, you are a contractor and they give you a 1099. So you might actually work for a company, but you're not an actual employee of the company. They give you 1099 and they don't take out any taxes. That basically falls into the same category as being self-employed. So you want to make sure that you show 2 years of tax returns filed to the mortgage lender, because the mortgage lender is going to calculate a cash flow analysis of the last 24 months, and that's how they're going to come up to your monthly income. Now, if you work for a company and they give you a W-2, it is really easier to qualify for a mortgage loan. As a matter of fact, there might be some even mortgage programs out there that only need 1 year of income in that case. But really, it's very cut and dried. It's very easy. Now, if you have income such as commissions or bonuses, or maybe royalties and things like that, then mortgage lenders will definitely want to get a 2-year income history as well. And that also includes overtime. So if you have a lot of overtime on your job, and a lot of people do, then you definitely want to show that you have a consistent 2-year overtime income from that overtime. So that really goes as far as the income is concerned. And basically with the income, the lender is doing a couple of things. The first one is mortgage lenders are going to calculate what they call the debt to income ratio. And basically debt to income stands for the percentage of your income that goes towards paying debt. And how the lender measures that is basically in 2 different ways. They're going to be taking all the stuff that shows up on your credit. So let's say that you have some car loans, you have a couple of credit cards, personal loans, and the monthly payments add up to $1,000. Okay. Now remember, the mortgage lender is not looking at the balance on each account. They're just looking at the monthly payment. So you have all these things and everything adds up to $1,000. You're looking for maybe a $300,000 home where the monthly payment will fall somewhere around $2,000. So you have the monthly payment on all the things that show up on the credit report plus the estimated mortgage payment, and that's going to give you total debts at $3,000. In order to measure your debt to income ratio, basically take that number and divide it by your gross monthly income. Very simple. So for instance, if you have $3,000 in monthly debts, including the estimated mortgage payment, and your gross monthly income is $8,000 a month, then you have a 37.5% debt to income ratio, which is a really good debt to income ratio. That's fine. Now, as far as debt to income ratio goes, most mortgage lenders will want to cap your debt to income ratio at 45%. So basically what that means is that no more than 45% of your income can go towards paying both debts that show up on the credit and the mortgage payment. So you want to cap it right there. There are going to be some programs that allow you to go into a little bit of a higher number, but once again, most lenders will want to cap it at 45%. So what about retirement income? Well, retirement income definitely works. And the good thing about it is you don't have to have a season for a year or 2. You can actually just become retired. And if you get a Social Security or you get a pension, the mortgage lender can use that right away. Some lenders might just ask you to prove it for a couple of months that it's being deposited into the bank account, but that's just about it. Retirement income is awesome. Obviously, it's fixed income, very easy to analyze, and no mortgage lender or bank will have any issues taking your retirement income to get you qualified for a mortgage. All right, number 3, we're going to talk about assets. And basically, when I talk about assets, I'm just specifically talking about liquid assets. And I'm talking about money in the bank. Money in the bank, whether it's in the form of checking, savings, or you have stocks. Yeah, those are really the most three liquid things, or maybe even CDs as well. So let's say you have cars that are paid off. That's an asset, but that doesn't necessarily count for a mortgage loan. So you want to just look at liquid assets. And assets are important because most mortgage programs require a down payment. Now, later in this video, I'm going to be talking to you about the mortgage programs and what are some of the ones that only require a very small down payment. And there might be even a couple of programs that don't require a down payment. But just speaking very frankly, if you're buying a house, make sure that you have some money, because whether or not you need a down payment, you are going to need to pay, in most cases, your closing costs. And basically, closing costs are the cost of buying a house. Now, a down payment, which is required for most mortgage programs, is the investment of getting into the property. What you're doing is leveraging dollars. You're leveraging, your down payment so that the mortgage lender gives you a much bigger amount of money to complete the whole purchase transaction. And that's why assets are important. Now, as far as asset goes, you want to make sure that you have at least 2 months of bank statements or the quarterly statement of your asset account, whether it's a 401k, an IRA, or stocks, bonds, and things like that. So all these things fall into liquid assets. If you have cash and the cash is in the form of literally cash and it's under the mattress, way before you even apply for the mortgage process, for the mortgage loan, you want to go ahead and put this money in the bank and let it season for at least 2 months. The thing is, guys, mortgage lenders have to see where your cash comes from. And normally, you could put some cash in the bank. You just want to make sure that it's no more than about 50% of your gross monthly income. So if you're making $8,000 a month and you have $10,000 in cash and you put all $10,000 into the bank, the mortgage lender is going to question where that money came from. And really, it's almost impossible to source where cash came from. So you want to make sure that you put your cash in the bank and let it season for at least a couple of months, and then go and apply for the mortgage loan. That's the thing about cash. Cash is always not a little bit tricky. It's actually very tricky, especially when you're looking to qualify for a home loan. Now, let's say that you don't have any money, but you have parents or family members who want to help you out, qualifying for a home. You can actually get a gift. A gift is basically money that a family member, an immediate family member, is going to give you for your purchase transaction. Now, remember, it's called a gift, not a loan. So if you're looking for loans from family members and things like that, that's not going to help, because you cannot take any loans or get any credit card advances or anything like that in order to put money down for a house. The money has to either come from you, which has already been saved, or invested because you have stocks, bonds, 401ks, IRAs, and things like that, but not lent from family members. Now, mom, dad, sister, cousin, actually not the cousin, an uncle, your spouse can gift you money. So, for example, if you are buying your first home and your parents want to help you qualify for the mortgage loan, but you don't have any cash in the bank, but your mom has, money, she can give you a gift for your down payment, closing costs. And really, one thing to understand, and a lot of people ask me this, is there a limit on how much money can somebody gift me? And the answer is no. You can actually get gifted just a minimum down payment. You can get gifted the down payment plus the closing costs. You can get gifted more than just the minimum down payment, whatever the case might be. You can get a gift. So that's going to cover assets. Hopefully that basically, helps you understand what mortgage lenders are looking for. So once again, 2 months of bank statements. If you have cash, make sure that you put that cash in the bank and let it season for 2 months. And if you are using stocks, bonds, 401k, and IRA, make sure that you show your last quarterly statement. You're obviously going to have to liquidate your stocks and then, put the money in the bank, but that's completely fine. And that's going to cover the whole portion about assets. Very simple. By the way, if you do have maybe like a car that you need to sell to make up for your down payment, that's completely fine. You can sell items to build your down payment, to build, your account for your closing costs. All you need to make sure is that you document everything, and I really repeat, document everything. So for instance, if you have a car that's already paid for and you want to sell it to put money for your down payment, the lender is going to ask you for a bill of sale. The lender is going to ask you for, a copy of the check or funds, verify from the bank that it came from the buyer of the car. And that obviously has to be in the bank, not in cash. Okay. So So you make sure that if you are selling anything, that's completely fine. You can sell items to make up for your down payment if you don't have it just yet. You just want to make sure that you document absolutely everything. All right, so that basically does it for the requirements of qualifying for a mortgage loan. So once again, you need income, you need credit, and you need assets. Not in the right order, but there you have it. And by the way, all those three things are extremely important. You know, not one is more important than the other. All right, now let's move on to the second part of this video, which is going to be what are the loan programs available for home buyers right now. All right, so the very first one that I want to talk to you about is going to be the conventional loan. The conventional loan is probably the most popular mortgage program out there. Maybe about 60% of all home buyers get a conventional mortgage. And there are three main requirements for a conventional loan. You need a credit score of at least a 640. You also need a debt to income ratio, no more than 45%. So remember, I mentioned how to calculate your debt to income ratio. So monthly payments on all the things that you have on the credit plus the mortgage payment, you know, that cannot be any more than 45% of your gross monthly income. And then finally, you need a down payment. Minimum down payment for a conventional loan is 3%. It used to be much higher in the past, but nowadays it's just 3% down. And that's going to be the conventional loan. Now, a few things that you need to know about the conventional loan program. Even though the minimum credit score is a 640, you don't want to get a conventional loan with a 640 credit score. Believe me, you're going to have a very bad interest rate. And also, if you're not putting down 20%, you have to pay the PMI, the private mortgage insurance, which is going to be extremely high if you have only a 640 credit score. So my suggestion to you is, if you are going to be looking into a conventional loan, have a credit score of at least a 700. The reason why, it's because that program is very FICO dependent. The better your credit scores, the better the interest rate is going to be, and also the better the monthly mortgage insurance payment is going to be if you're not putting down the 20%. Now, with a conventional loan, you can buy a primary home, you can buy a second home / vacation home, and then you can buy also an investment property. It's actually the only program that allows you to purchase a second home and an investment property. So if you're looking at any of those two things, that's the conventional loan. That's going to be the one for you. All right, the second most popular program is going to be the FHA loan. And FHA is a very, very popular program because it actually allows you to purchase a home even if maybe you've had some blemishes on the credit. So you have some things in the past. It's a very heavily subsidized mortgage program by the government. Stands for the Federal Housing Administration, which is actually HUD, the Housing and Urban Development. And FHA requires the main things. You need a credit score of at least a 580, which is awesome. I mean, it's very achievable for a lot of people, especially first-time home buyers. So you need at least a 580 credit score. You need a 3.5% down payment. That's the minimum down payment that FHA allows you to do, 3.5%. And your debt to income ratio, the max debt to income ratio that you can have is 57%, and that includes the mortgage already. Okay, so remember, we calculated debt to income ratio with adding the monthly payments that show up on the credit plus your mortgage payment. That cannot be any more than 57%. This is the reason why the FHA loan is very popular. Especially, it's very popular with first-time home buyers because most first-time home buyers want to have a 10-20% down payment, so 3.5% is very accessible. Also, the FHA loan is really good about the fact that you can buy a home with a 580 credit score. You don't need anything, like I said, on the conventional loan, a 700 or something like that. And the only drawback about the FHA is the fact that you are required to pay the mortgage insurance. If you even have a much bigger down payment, like 10-20%, you're still required to pay mortgage insurance. So that's really the drawback about this loan. For my clients, for instance, if you have to do an FHA loan, I always work on having you switch over to the conventional loan program once you have enough equity, which normally happens after a couple of years. But that's another conversation. That's another video for the future. For now, let's just focus on basically what are some of the requirements. And that's exactly what you need. A 3.5% down, 580 credit score, and maximum debt to income ratio is going to be no more than 57%. Really, most mortgage lenders will be able to help you with an FHA loan. And actually, most banks as well will do the same. All right, now let's talk about my third program. And this is by far probably my favorite program. And it's the VA loan. And the VA is the Veterans Administration Loan. There's a caveat about this one. You have to be a veteran to qualify, but it's really my favorite mortgage program because, one, I have a soft spot, I can't even talk right now, for veterans, and man, I appreciate the service and I enjoy working with veterans with this loan. Really, one of the main key features about this mortgage program is the fact that it's 100% financing. You don't need a down payment. It's it doesn't matter whether you're buying a $100,000 home or you're buying a $500,000 home. You don't need a down payment. It's great. The second thing is that there's also no mortgage insurance required on this loan. So if you compare it to, for instance, the conventional loan or the FHA, the monthly payment will be lower because you don't have that PMI, whether you're putting down 20% or not. For the VA loan, actually there's no minimum credit score. The VA does not have a minimum credit score to qualify. It's basically be set by the mortgage lender that you go to. And mortgage lenders will have at least a minimum credit scores for a VA. For most lenders out there, the minimum credit score would be a 620. You may find lenders that will help you get a VA loan with at least a 580 credit score. That's going to be like the very, very low. But there will be lenders, listen to me on this one, there will be lenders that if you do put some money down, about 10% down, you can get a VA loan with a 520 credit score. They can go down that low, and I've seen it in the past. And even though it's not as popular because most mortgage lenders will, require at least a 620 credit score, there will be some options where you can get VA financing with at least a 520 credit score. Again, it's because the VA does not have a minimum credit score for the program. So that's the VA loan there for you. Maximum debt to income ratio for VA loans can vary based on the borrower. I've seen that really, you can even go sometimes to 55% debt to income ratio. Sometimes it could be a little bit lower, but it's also a really good loan for that debt to income ratio. So if if that DTI is a little bit higher in your case and you're a veteran, you might be just fine. Okay, so that's the VA loan for you. With VA. Also, it's only owner-occupied properties. You cannot buy any second homes or vacation homes with it or investment properties. It has to be your primary home only, and the only other person that can be on the loan is your spouse. Okay. Now, if you are the spouse of a deceased veteran, you may also be able to qualify. So, that's the VA loan there for you in a nutshell. And now let's move on to the fourth program, which is the USDA loan. USDA is the United States Department of Agriculture loan. This is also an amazing mortgage program, and the reason why it's because there's no money down. It's 100% financing. So very similar to the VA in that end because it doesn't need a down payment. The requirements, though, however, you have to live in a rural area. It has to be designated rural area by the USDA. And actually, I'm going to be linking the USDA eligibility map on the description box of this video because there will be zones that won't qualify for USDA, even though they might be rural. So you want to make sure that if you are looking for a property and you want to get into this USDA mortgage, you have to be sure that it's actually a property that's deemed USDA approved by the USDA. So I'm going to be linking that video. That link into the description box once again. Now with USDA, most lenders will want you to have at least a 640 credit score. Okay. This is specifically for owner-occupied properties. You do not have to be a first-time home buyer. You can be a repeat buyer as well, but you may not be able to have other properties on your name. So if you have another mortgage or you have another house, you cannot get this loan. This loan is only if you don't have any other properties, and it's going to be your owner-occupied home. There's another caveat on this loan program is that not only you have to be in a USDA area, but also there is a maximum income limit for home buyers, and that's actually gonna be on the USDA website because if you make too much money, this loan is not gonna be for you. There's gonna be a cap on how much income you can have, and obviously that will change whether you have dependents or if you're married, in all those things. So that's also gonna be in that link that I'm gonna be putting on the description box once again. USDA also amazing program because heavily subsidized, especially by the United States Department of Agriculture. Once again, low interest rates. Maximum debt to income ratio is going to be 41%, normally 41%. So you guys want to make sure that you don't have a lot of debt outstanding if you want to qualify for this loan. And you do want to make sure that you have at least a 640 credit score. Really, one good thing about this loan, though, and this is unique about this USDA mortgage program, is the fact that it's the only program that allows you to finance closing costs. So, as I mentioned to you before, when you're buying a home, you need a down payment and you need money for closing costs. Closing costs are the cost of buying a piece of real estate. with the USDA, if the property appraises for more than what you're purchasing it for, you can actually put those closing costs into the financing. So I'll give you an example. If you're buying a $150,000 home and the house appraises for $155,000, then you have $5,000 right there that you can use to finance your closing costs. So I've had, in many occasions, I've had clients who buy a home with an USDA loan and they don't have to put absolutely any money down because the property appraised for more. It's a 0% down program, and there you go. They had enough money right there in the equity already to finance those closing costs. Okay, so amazing mortgage program. Once again, link to where you can get the USDA, the zones for the USDA will be in the description box below. Loan number 5 is going to be the jumbo program. And jumbo is not a government loan. This is basically a private mortgage offered by banks and lenders for people who need more money, because in some cases the conventional loan limit might not be enough for the property that you're looking for. So this for big mortgages in most states. The conforming conventional loan limit is $548 to $550 unless you're living in a place like California, New York, DC, and places that are considered high balance, where you can get up to $825,000 and then some with a conforming loan. So jumbo is basically anything that helps you get more, more than that. So if you're looking for $1 million, $2 million, a jumbo, most mortgage lenders that offer jumbo loans can go up to $5 million on the loan. You have these that are called super jumbo that can help you get up to $7-10 million as well. That mostly goes through private banks. But that's basically, in a nutshell, the jumbo loan program is going to be for people who are looking for more mortgage, more money, because either A, just really the conforming loan limit doesn't do it, or 2, you're looking for a luxury property and you need more than just a conforming loan limit. So that's the jumbo program. Jumbo programs typically require a 20% down. They're also going to require more, much better credit scores. Honestly, guys, if you're looking for a jumbo loan, you need to have at least a 720 credit score. Most lenders won't even help you get a jumbo with at least a 720, 700. You do need that 20% down. You're also gonna have to have that low debt to income ratio. So debt to income ratio should not be any more than 43%. I know, for instance, the lender that I work for, that's 43% is the most that we can do in a jumbo financing. And it's okay if you're looking for a primary home, second home, / vacation or investment property. So that's going to be the jumbo program right there for you, which obviously won't be most people. This is for those who are looking for much more housing than what the conforming or any of the other mortgage programs can help you get. So that's the jumbo loan in a nutshell for you. All right, so we have basically talked about, so far, we talked about the items that you need to qualify, and we've talked about the most popular mortgage programs out there for you. One thing that I did not cover was down payment assistance. Guys, for down payment assistance, this is if you don't have money for a down payment or you need some sort of government help in order to qualify for a home. Make sure that you look, specifically in your state, in the area that you live in, for those programs that may help you with money for down payment. But now moving on from this, let's talk about the number 3 thing, which is, where should you go and get a mortgage? Where can you go and get a mortgage loan? And there's going to be 3 places, literally, where you can go and get a mortgage loan. Because remember, you can't go and get a mortgage loan to the FHA. You can't call HUD and ask for a home loan. You can't call the VA, the Veterans Administration, and get a home loan, or the United States Department of Agriculture. So you have to go through a mortgage lender that's actually going to give you the money to purchase your property. Now, there are 3 main entities that will give you money for a mortgage loan. You're going to have your banks. Banks will be like a Wells Fargo, a Chase, a SunTrust or Truist, whatever it's called nowadays, etc. So you're going to have the big box bank. You're going to have number 2. You can also go to a mortgage lender. Now, most mortgage loans are offered by mortgage lenders. These are non-depository institutions, meaning that mortgage lenders don't open bank accounts, they don't open checking savings, they don't do anything else besides give you a mortgage. That's a mortgage lender right there for you. And number 3 will be a mortgage broker. Okay, so difference. Bank, you have the big bank that obviously does pretty much everything. you can go there, and if you have a relationship with the bank, sometimes that'll help you. It doesn't mean that it'll help you get qualified a lot easier. Sometimes it just means that you might get a little bit of a better interest rate because you might have another account with the bank, or you already have all the things right there. So sometimes that could be a little bit easier. But however, the drawbacks of working with a bank are actually a lot. The first one is banks can take a lot longer to close on your loan, and in a market where sellers sort of mandate the market, you want to close as quickly as possible. Banks, unfortunately, don't do that very well. I'm sorry for you guys who work for banks, but that's basically the stigma that most banks have when it comes to mortgage loans. They take a little bit longer to close. Number two, it could be a little bit more difficult to qualify for a mortgage loan through a bank. So for instance, there was a time where Chase Mortgage only allowed people that were putting down 20% in a 720 credit score to purchase a home. Banks may not also have all the mortgage programs available for you. So some banks may not offer FHA, or if they do offer FHA, they'll require much better credit scores than actually what's needed. And then once again, it's something that will be a little bit more difficult to get through. But theoretically speaking, working with banks it's fine. It's no big deal. You just gotta make sure that you do qualify. You want to talk to the mortgage banker that's in the branch, and make sure that you get pre-approved. The second place is obviously the mortgage lender. Now, most mortgage lenders will be able to give you a mortgage through any of these programs that we just talked about. Mortgage lenders will also, they'll only focus on giving mortgages, and I think that's so important because you just want to deal with a person that's a professional in what they do every single day. So for instance, in my own case, doing mortgages is everything I do. I don't know how to open a checking or savings account. I just know how to originate a mortgage loan, and that's what you want, especially if you want to get the best guidance. Mortgage lenders will, won't have that many, guidelines, overlays, and things like that when it comes to giving you a mortgage. So, that's where you're going to be able to get a 580, credit score through an FHA loan or something along those lines. So those are really the big benefits of working with a mortgage lender, as well as, the channels, the communication channels tend to be better. Closing timeframes could be better as well. Most mortgage lenders will also have their underwriting and closing departments in-house, meaning that it's all in the same company, and that's going to help you expedite your loan, especially if you need to have a very fast closing. That can go through a mortgage lender. Okay. The third place is going to be your mortgage broker, and really the mortgage broker is a person that takes your application. They're not going to give you the mortgage. They're going to take your application. They're going to offer you a loan, but they're going to take your application and shop it with other lenders and banks in some cases. And that's, that's basically the benefit about working with a mortgage broker, is the fact that, maybe if you didn't get the financing through a mortgage lender or through a bank, the broker can take your application and show it to other lenders, and one of them will be able to give you the loan. The other positive thing about working with a mortgage broker is the fact that sometimes you may get a better interest rate through the mortgage broker than you would through either a bank or a mortgage lender. So there's a huge benefit of working with a mortgage broker as well. Some of the drawbacks about working with a mortgage broker is just going to be that they don't give you the loan. So if your loan has any issues or anything like that, sometimes you may have to wait until you get an answer from the mortgage lenders that's actually giving you the loan. There could be a little bit of mishaps in communication, and maybe even closing sometimes. Sometimes, mortgage brokers have been extremely efficient, lately, at least in the last few years. And but sometimes it does take a little bit closer to close. So a little bit longer to close, sorry. So, but that's basically what it comes to, all these three places. There's some of the positives, some of the drawbacks. And that's really, guys, in a nutshell, this is how you get a mortgage loan. Now, I gotta, just sort of to wrap up this video, the process of buying a home is very simple. You first and foremost, before you even start looking for properties, you want to make sure that you qualify, or at least get the right guidance. Now, this video, hopefully I was able to give you, the blueprint on what are the things that mortgage lenders are looking for. But the best resource, guys, is to go strictly to the mortgage lender. Don't be afraid to get your credit pulled. It's not going to decrease your credit scores. It's going to be a lot better to have somebody, a professional, to just let you know exactly what are the things that you need in order to qualify, because you might need to pay down some credit cards to get your credit scores better. The lender can tell you exactly what to do. You know, you might need a little bit more income. They can tell you about how to get somebody else to help you as a co-signer. So the very first step, guys, is go and get pre-approved. If home buying is something that you want to achieve this year, this summer, or this winter, or next year, the very first thing is get an idea from the mortgage lender. Go get it pre-approved. Have them tell you exactly what are the things that you need specifically in your own case, in your own profile. And that way they can tell you what would be the best mortgage program available for you, as well as what would be the most amount of money that you can borrow, how much house can you afford, and answer all those hard-pressing questions, whether you're a first-time home buyer, a repeat buyer, or a seasoned buyer, or whatever kind of buyer you are. But that's basically the very first start. And most mortgage lenders will not charge you to get you pre-approved. So I mean, it's something that will be very simple. For instance, I pre-approve my clients within 24 or 48 hours. So it's something extremely quick. But there you guys have it. Hopefully this video was able to help you. Once again, if you liked it, make sure that you go ahead and like it over here somewhere on this video. Subscribe to the channel, and share it with people that you care about, and you want to show them the same information. And hopefully this was a really good guide for you to follow. If you have any questions, make sure you put them on the comment box below. My email will be somewhere on the description box as well. And I will see you guys on the next video. Have a good one. Take care. Goodbye for now.